friends, and welcome to the CUInsight Network. My name is Robbie Young. I'm the Vice President of Strategic Growth here at CUInsight, and it's my job on this show to have conversations with thought leaders who support the credit union community. We'll identify issues affecting credit unions and discuss best practices that will help us learn from one another and strengthen our credit unions. My guest on today's show is Jon Ungerland, CIO of DaLand CUSO, and Jed Meyer, CEO of St. Cloud Financial Credit Union. Jon, Jed, thank you so much for being here.
Thanks for having us.
Great being here.
So, to start off, for those who are not familiar, can you share a bit about DaLand CUSO and how you're supporting credit unions like St. Cloud Financial Credit Union in reaching their strategic goals? And why is that partnership so meaningful in today's environment?
Yeah, sure. Well, DaLand is an organization that's been around for about 15 years, and our mission has always been to serve credit unions and community FIs and keep them relevant, especially in areas of modernizing technology, maintaining control of data, and using data and digital tools to keep themselves as valuable, trusted epicenters in their community economies and in the communities they serve. One of the ways that we're doing that now is through our innovation product that we call Coin to Core. We've always been really passionate about helping credit unions and community FIs get a better ROI and get more efficiency out of their core technologies and their core data, because we know how crucial those are to modern business and how spendy they can be for those organizations. So maximizing ROI on them is key. And about 7 years ago, we started really paying attention to the evolution of DeFi, or distributed ledger technologies, and digital assets. And we started to look closely at how those were going to challenge community FI business models. And more importantly, how things like deposit flight and deposit drain might impact these organizations, and how the evolution of these new networks like Bitcoin, Ethereum, USDC, et cetera, how evolution of these global networks for storing and moving money could become an essential part of any FI's strategy. We developed our Coin to Core TradFi DeFi bridge, as we call it, which allows community institutions to connect to these next-gen money networks, these new money networks, DLTs like Bitcoin, for example, or USDC stablecoin, US dollar coin stablecoin. And we wanted to ensure that local financial institutions had a cost-effective, secure, efficient, turnkey way to stay connected to the future of money and reach out and process and store data on behalf of their members and conduct transactions on these new global money networks, so that local financial institutions wouldn't be unplugged from the money business, and they would be able to continue serving their communities and their consumers, whatever the form of money might take that consumers and communities would use.
Jed, do you have anything to add to that?
Yeah, I would just say that from our perspective as a credit union and looking at this space, about 5 years ago, we identified, hey, this is very material. Our members are moving there. Our liquidity continues to outflow into those spaces. And as a CEO who has really had a lack of knowledge in this space, I really started from ground zero with a lot of skepticism. I think very similar to how CEOs probably are looking at it today. I might have just been ahead of the curve a little bit, but just really going out and identifying in the space, where do I think it's going? Where will my members go? How will this impact my future business? And as a small scaling credit union, we always have to do the work before we have to, because human capital is our number one challenge. Actual capital is number two. And so we have to stay out ahead of things. And we don't have to launch. We don't have to always be right, but we have to do some prep work so that if our members ever demand something from us that we're not prepared or have done no work on, we have to take all of our human capital and actually throw it at that. And that's not a great way to scale a business. So we're always looking for, where do we think our members will be in the future? How are we prepared for it? If that answer comes true, what will we do when our members demand that? And starting that prep work and interviewing a lot of people in this industry, we found DaLand. And DaLand had a great strategy. We interviewed a ton of other people in this market, but getting to a place where we're able to use our core to enter into these markets and plug into these markets gives me a few strategic advantages. Number one, I have multiple use cases available to me through this process versus me trying to find a third party and pick a winner or pick one specific use case that I think is going to be the highest and most prevalent today or for in the future, I actually have the ability now, because my core and infrastructure is built to plug into any DLT network over time, I can innovate and move and evolve in this space as regulation and this space continues to emerge. And so I really feel good about our strategy, our partnership with DaLand, and the ability that we can stay plugged into the future of money. Right now, we have close to 3 to 5% of our deposits outflowing to exchanges, and we know we're plugged into the networks as where they are flowing. And so as regulation continues to evolve and continue to take shape, we know we're prepared with the right products to be able to serve our members and our community in this space and really keep that wealth local, because that's the number one thing. As a local FI, if we can't continue to support storing our members' wealth, 100 years ago, it was gold bars behind steel cages. Today, it's monetized data. And at the end of the day, we serve a strong purpose in our community, and that's really keeping the local economy resilient, starting businesses, helping businesses start, and really ultimately being that linchpin to a strong economy in our local community. And as the world continues to evolve into a place where it's a more global money network, we have to insert ourselves into these roles to continue to facilitate the important role we played in our community over the years. And what we found is DaLand is the absolute right partner for that for us.
Thank you, Jed. That sounds like such important information, but could you expand on that even a little bit more? St. Cloud Financial Credit Union is tackling deposit outflows and member engagement in really innovative ways. Can you share how your partnership with DaLand is helping address these challenges as money itself continues to evolve?
Yeah, I think the biggest thing is we've had the luxury of really having strong thought leaders at DaLand who really know this industry for us to really see the entire forest, if you will. I know there's a lot of hype on stable coins. I know there's a lot of hype on proprietary stable coins. We are launching the Cloud Dollar here at St. Cloud Financial, our own white label stable coin with a partnership with Metallicus. We're super excited about the use cases that exist there. But as I watch the industry continue to talk about this, I even saw a piece here recently where it talked about how stablecoins are not a threat to deposits. If you look at what they're saying from a white label stablecoin, of course they're not. But the reality is that most of the actual consumer behavior in stablecoins are not at a credit union white label stablecoin. And so at the end of the day, with 300 billion sitting in stablecoin networks that are not proprietary credit union stablecoins, I need to be able to plug into those networks because my consumers are using them and will continue to use them. So as we look at this industry, I think it's really, really dangerous for us to look at it and say, hey, deposit outflows are not a threat to us, because what we've seen here in 2023, we had about, I'd say 300 million in deposits back a couple of years ago. About 1 million of our deposits were outflowing to exchanges. Last year, it was 5 million. This year, we have probably about 365 million in deposits, and we're going to probably approach 15 million of our deposits leaving to exchanges. And the problem with that is that in the DeFi space, as a central liquidity source, a centralized ledger, which are two of our main functions as a local FI, we're not needed in that space. And so in every innovation over the last 100 years, as deposits have left, if we weren't part of that transaction, at some point, the centralized ledger caused it to come back to our credit union. At some point, we had a chance to win that business back or have it come back to us without us fighting for it. And when the money and liquidity leaves us into those spaces, the centralized ledger is not necessary in a decentralized network. And so we have to establish our place as the access point for our members, as the trusted advisors for our members to operate in this space. And we have to build a bridge back to the TradFi and allow our members to move their money back and forth, because deposit outflows will be a huge issue for us as we continue to move forward into this space if we do not plug into these networks and process the data that's happening. The form of money is changing to monetize data, things of value, and the rails at which it moves is changing as well. And our core infrastructure without a partner like DaLand is not positioned for us to actually operate in those spaces. And so when you look at things like 300 billion in current stable coins, 4 trillion in a DeFi market, 30% of loans already being done by fintechs before Bitcoin-backed loans actually happen. Let's talk about Bitcoin. It's bigger than the entire credit union industry from a market cap perspective. So when we start talking in terms and watching the industry continue to get confused a little bit about, hey, that's liquidity, don't worry about it. At some point, I've been a CEO here now 11 years. At some point, we have to draw the line in the sand and say, hey, we're not going to continue to allow death by 1,000 cuts and outsource our traditional business. And that's my fear in this space, is that if you fast forward 10 years, the number of things that will impact our core business as a credit union and our local FI, the number of partners I'm going to need in this space, if I continue to look for product by product innovation from third parties, not only am I going to have to manage a lot of third parties, but I'm also going to be outsourcing my consumer and the relationship to other people who can do things like Bitcoin-backed loans. And so when you look at from a credit union CEO perspective, I don't want to outsource my relationships. I want to actually facilitate those relationships, grow those relationships, protect those relationships that keep them resilient in our local community. That's the value proposition that I add. I have to do a little bit more work in this space to continue to serve my community in that manner. But deposit outflows are a real thing. And partnering with someone like DaLand allows me to plug into these networks. And as regulation continues to evolve, we have a lot of different product sets and use cases that we'll be able to utilize for our members so that we are the primary access point in our community to the DeFi space.
So you've both emphasized the importance of credit unions engaging with and definitely not avoiding the digital asset ecosystem. What does responsible participation look like for credit unions, and really where should they start? Jed, I would love to hear from you. And then Jon, if you could expand a little bit for us.
I think the first place is education, right? So when I started researching this place 5 years ago, Google was like the best place for me to find education. And so one of the first things that we did is we uncovered very quickly that, this space as an emerging market, there are a lot of self-taught experts in this space. And so we needed to go find a bunch of those. And so one of the first things we did is we created a nonprofit with self-taught, very high prevalent people within our community, from doctors to attorneys to business owners who had a lot of experience in this space. And we created a nonprofit called the Minnesota Crypto Council, who's been providing education for our consumers in our market for the last 3.5 years. And so that's the first place. You have to educate yourself. You have to be an educational resource for your members, number one. And then number two, you have to try to anticipate where you think this market is going and how it's going. When you talk about, should we operate in this space? Well, we have to operate in the space. Protecting local wealth and local value is why we exist today. It kills me when I see bad actors operating in this space. We have bad actors in TradFi all day long, and my team is amazingly working with our members to help protect them, help them when they make mistakes, protect their wealth. And in a space that, again, continues to become completely globalized, how do you keep local economies resilient? We have a role to play here. We need to be inserted in this space. Or at the end of the day, community FIs will continue to go away at a faster pace than they already are today. And I don't think that's a very strong value proposition for local communities as community FIs continue to leave their communities. Because at the end of the day, San Francisco, Charlotte, Minneapolis don't know the farmer down the street, but I do. And ultimately what happens in their world impacts my world. And I have to be able to have answers for them that protects their wealth, gives them opportunities, and keeps that liquidity local.
Yeah, I would expound upon that a little bit, Robbie, and take maybe more of a technical, broader industrial vantage point on the question. One of the things that financial institution leaders need to be doing right now is getting outside the bubble of financial services, especially local FI services. I just came back from a very large conference in DC that was a number of different industrial types of entities and disciplines, and they were convening specifically to discuss the future of money. And what I found intriguing about that conference is that there really wasn't anybody at the conference that doubts whether distributed ledger technology, blockchain technology, plus AI, plus a number of different innovations in data processing. There's nobody that disputes whether or not that is the future of money. They simply are debating what kind of regulations and legislation and controls are going to exist around that future of money. I mean, whether we look at it economically or technologically or sociologically or geopolitically, it's pretty evident that the electronic dollar is very long in the tooth and is no longer a competitive mechanism for storing or moving money. The risks are too high in electronic dollar only business. The costs are exorbitant compared to new technologies like DLTs and DeFi. The security and encryption around these new solutions is better. They pair better with a world that's driven by AI. So the future is these new money networks. What I think FIs leaders need to be doing is understanding how their industrial counterparts and their customers, like small businesses, entrepreneurs, industrial players, are looking at these technologies. Because if you step outside the typical FI conference circuit and you listen to what people are saying, it's very evident that if anybody's going to be offering financial products and services in the future, they're going to have to be financial products and services beyond the electronic dollar, and probably very specifically plugging into all these new money networks. And that's precisely why DaLand has built a solution that allows people to establish new rails and new connections to all the different ways that money is going to move. We're definitely moving towards a future of tokenized assets and tokenized stock and tokenized loans and tokenized participation lending and tokenized insurance and tokenized titles. And what all that means in plain speak is that all of these new networks, these new distributed ledger and blockchain networks, are going to control and store all the data necessary for financial services. What DaLand knows is that we've built the architecture and a gateway that allows FIs to purchase and partner with one solution, allows them to connect their in-house expertise, their established historical financial operations. They can put this whole world of tokenized wealth and property at the core of their financial services operations, and not create a bunch of unnecessary redundancy, inefficiency, duplicated expenses, additional compliance burden, so on and so forth. So as we look at where things are going, I think we're in this interesting moment where stablecoin mania is a temporary thing, because stablecoins are the one area where there's been any indication of regulatory clarity. But ultimately, the stablecoin mania is the door through which financial services leaders will need to walk into the broader world of digital assets and tokenized assets. And fortunately, we've already built a very functional portal and gateway to that entire world. And we would encourage local FI leaders to be connecting to the whole world of digital wealth, and not focused only on the rather small and myopic slice of, white labeled stablecoins during this stablecoin mania moment.
So delivering that unified experience across traditional digital assets really sounds complex. Jon, how does DaLand approach this in a way that maintains member trust and meets regulatory expectations?
Yeah, well, for the second part of your question, the regulatory expectations, let's be blunt, there's a lot of ambiguity and lack of clarity there. And that's part of the problem, is that the industry needs its regulators to pivot and advance swiftly if they want to keep local financial services and heterogeneous financial institutions strong in the U.S., if they want to keep local institutions as trusted players for local wealth. They need to pivot away from their fears, anxieties, misconceptions, maybe naivety around these technologies. And rather than getting hung up on debates about custody and whether you should have an internal or an external wallet or a third-party vendor, I would strongly encourage regulators and legislators to look at these new money networks as simply evolutions in how money data is moved and stored. And in reality, local financial institutions exist to service wealth. There's no caveat on the forms of that wealth, and there certainly weren't any restrictions on them plugging into debit cards, credit cards, bill pay, etc. They evolved as the transmission of money and the storage of money evolved, and this is just the next evolution of that. So I think that the regulatory and legislative side of things needs to provide clarity so that folks can understand where to go. And to the first part of your question, yeah, it's difficult, I think, but it's often made overly complex. And what I mean by that is a lot of the projects that are out there right now are projects where people have built something in the DeFi space. They've built a crypto wallet. They've built a side chain like a Cardano chain or a Hedera chain or, some other chain. They've built a separate platform, and they're trying to force that external DeFi platform back into the banking space. We went the other route. We said, hey, these institutions are fundamentally already experts and compliant and audited and regulated and insured when it comes to processing money data. So let's treat these new global networks with $4 trillion of wealth in them, value in them, doing more annual volume than Visa. Let's just treat those as new money networks and tie those into their existing operations, their existing FI core banking business. And that simplified it, right? We focus on the elegantly simple. We don't think that every local FI can or should have to stand up and split their operations into a TradFi wing and a DeFi wing. That would be exorbitantly expensive. It would be cost prohibitive. It would be irresponsible. But that's the way things tend to go with these crazes and vendor add-ons. What we focused on is how do we take this wealth where these networks where these members are already moving wealth and they're already finding utility and value, and simply allow the institution to safeguard and service that wealth as if it's living on any other network like Visa, MasterCard, Bill Pay, whatever. And there's certainly precedent for that. So we think that it's we can simplify it both in terms of cost, efficiency, security, compliance burden, operational overhead, et cetera, with our approach of just plugging the existing banking data processing business into these new networks. And we also believe that we can help the regulators see that this really isn't some big, scary deal that has to fracture the banking industry. It could. If regulators force the issue of moving this data out of bank data processing and into external wallets, it will fracture the industry. And that's one reason that we're trying to help institutions and regulators and legislators alike understand that there's a way to actually synthesize these two industries and open up a whole new set of revenue streams and service streams. And indisputably, we know that the consumers, they are not going to live in a trustless world. What I mean by that is these decentralized forms of money, Bitcoin, Ethereum, et cetera, USDC, they're actually designed to operate without an institutional intermediary, without a trusted banking partner. And that's great for crypto anarchists and Bitcoin maxis. But the reality is most human beings don't trust themselves with $1 million or $10,000 or even $1,000 in digital wealth. And they're going to look for institutional partners they can trust to service them and steward their wealth. Above that, we're pursuing this ideal that, putting crypto wealth and digital asset wealth only in external wallets is not a great move for banking and for communities in general. So I don't really like the idea of a world where folks have $10,000 or $100,000 in digital assets and it's forced to live outside the banking ecosystem, because that's a world where that wealth isn't being used to fund small business loans, to fund access to financing for underserved markets, to capitalize a cooperative local economy. So we're certain that what we've built allows institutions to capture that digital wealth and service it and make sure that it's Cs and freeze compliant and all the important things. But more importantly, the consumer can continue to trust the institution and their wealth can continue to benefit the local community.
That's so interesting. Jed, can you talk a little bit about how this plays out in the real world at your credit union and for your members?
Yeah, 100%. Well, first, what I want to talk about is that in our industry, I want to touch on something Jon said. Going to conferences that are outside of the credit union industry, it's funny, when I go to a credit union conference, it's oftentimes trying to convince people that this is real, that they have to do something here, that these are money networks. And then being at a conference where it's outside of the industry, that's not a debate. It's an actuality. It's the reality. You don't have $4 trillion just sitting out there in something that's going to go away tomorrow. And those deposit outflows, to Jon's point, are very important to our credit union, because every time a member takes money out of TradFi in my world and they put it on a ledger stick and then they go downstairs in my office and put it in the safe deposit box, that's liquidity that's sitting in my institution that I don't know it's there, how much is there, and I'm not able to then ultimately redeploy that liquidity within our institutions to start small businesses, to help those things, which is what we do. And I wanted to touch on another point of, I've been asked a lot of times of like, why are credit unions, especially a $400 million credit union in central Minnesota, why would you find yourself in the spot you find yourself in? can. And I think when you look at really why these networks were created way back when in the 2008, 2009-ish area was really for more control with less manipulation over the wealth that consumers had. And to be honest with you, when you talk about an intermediary, and I know the Bitcoin purists or the crypto purists would be like, hey, we don't want intermediary, to Jon's point. But the reality is we're the closest thing that exists in the space of what they are looking for, which is more ownership, more sovereignty over their wealth. As a cooperative owned financial institution, there's no better place for us to build the synergies that exist in a DeFi world with a financial institution intermediary, that we don't have to be the centralized ledger, but we can still be the trusted resource, the access to those space, and the place that they can store their value and ultimately use it in a very convenient and advantageous way than a ledger stick in our safe deposit box. Last thing I'll say is as we continue to evolve in this market, we look at legislators. And one of the things that I talk oftentimes with our legislators, and we have a great relationship. We've been working with the NCUA for 3.5 years. We've been working with the Minnesota Department of Commerce for about 3 years. And local legislators it's great that 40 states around the country have said, hey, we're going to allow our state to invest in these type assets, our employees to invest in these type assets. Where are they going to store it? Are we going to send all that liquidity out of the state of Minnesota to some neobank, to Wall Street? Where are we going to send it? Why wouldn't we keep that liquidity in the state of Minnesota, leveraging it to continue to help our communities and help the wealth in this state in starting new businesses, doing some of those things? So I think it's really important for credit unions to understand that, hey, you need to take a deliberate approach at your education in this topic, understand not only how it will impact you from a defensive perspective, but it's really fun to go to conferences and start talking about the opportunity. And that's not happening quite yet in credit union conferences, because there's a huge opportunity for credit unions to gain market share in this space with partners like DaLand.
So again, on this topic of the cruciality of expanding horizons right now and dispelling some of the myths and misunderstandings in the FI space, I just came back from a conference where I spoke on a panel, and on the panel right before me was the head of development for JP Morgan, plus there was folks there from Fidelity and folks there from Coinbase. And if I could get one message across to all the local FI leaders listening, if you know where to look, you can hear JPM and others say the quiet part out loud. So at the conference I just went to, there was the lead developer who said they have 500 developers inside JPM working on tokenized dollars and tokenized wealth and positioning JPM to be the leader in that space. Well, what that means is, and same with Fidelity, they have a couple hundred working on similar projects. What that means is that institutions like St. Cloud, like Ultra, like Blaze, like our institutional investors, they're ensuring that there's going to be a credit union-owned solution for the reality of digital wealth, wealth networks, tokenized wealth, et cetera. What we need to understand as an industry is that the big bank players have already determined that and done a very effective PR campaign, propaganda campaign, to ensure that most players in the local FI space are behind the curve. We are going to see large banking institutions suddenly support Bitcoin deposit accounts, Bitcoin savings accounts, Bitcoin yield accounts, Bitcoin-backed loans, tokenized assets on Ethereum, and it's going to come so fast. It will be breakneck speed and possibly existential threat. I'm grateful that firms like shops like St. Cloud, Blaze, Ultra, others have come along and invested in ensuring that there will be an industry-owned digital asset switch and gateway in DaLand that can keep local FIs ahead of where JPM is, because the other benefit is I know what they're building because I just listened to them explain it, and I know that we can provide a superior path, a more advantageous, flexible, strategic path for local storage, stewardship, and use of wealth in an era where wealth becomes streaming and digital.
Amazing to be able to have a partner like DaLand to certainly suss all those things out and really stay on the cutting edge to make for stronger credit unions. So to wrap up, I would like to ask a question of both of you, and I'll start with you, Jed. Looking ahead, how do you see the role of digital assets shaping the future of credit unions and their ability to stay relevant to members' financial lives?
Well, some of that really depends on how the credit unions will respond. I think I wrote an article very recently that just said, hey, that story's not written yet. And I'm hopeful. We're beating the drum as loud as we can. It's not something that credit unions should be looking at to say, hey, we'll get to that in 2028. To Jon's point, this is going to happen faster than you expect it to. It already has. And so the time is now. Our industry has been a defensive strategy industry, risk adverse at times, deliberate risk when we're at our best, in my opinion. But innovation is moving so fast today. You can't have large credit unions having 30 executives in a room for 4 months to make a decision. And you also can't have small credit unions believing they're too small to do anything in this space because the consumers are moving. And so at the end of the day, the way money moves, the form in which it moves. Again, we hear it all the time. We've used it all the time. But, at the end of the day, nobody stopped watching movies, but Blockbuster no longer delivers movies in the way that consumers wanted to. And so they're no longer in business. And so I think this is a little bit different than some of the innovations we've seen over the last 100 years as credit unions. It's really a larger shift than we've seen in the past. And it's not the boomerang effect. When we faced 2009, I worked at credit unions in Elko where we kept talking about making decisions on interest rates rising. Well, they didn't rise for 10 years from those moments. And so as credit unions, we have to lead. We have to go out. I don't believe innovation is reckless, kind of going out there. I think it's prepared readiness a lot more as it relates to what could the answer be and what would your answer be should that happen. And so I really encourage the thought leaders in our industry to really start getting into the space so they can apply their talents and understanding directionally where this thing's headed. Because our consumers are moving in this space. They continue to prove that to us over and over again. And at the end of the day, they're not going to come back, especially the younger generations, into the traditional financial world the way it looked 10 years ago, 50 years ago. It will look different. We need to be a part of that story. We have an opportunity to create exactly what they're looking for, especially in a cooperative nature. We have a competitive advantage as credit unions in being closer to our members, more intimate with our members, and owned by our members. And so at the end of the day, I think this will be a revolutionary shift in the financial industry. I think regulators are working at it. We always want them to move faster, but I appreciate the deliberate and intentional kind of approach to this, make sure that we do it right and protect consumers. Because at the end of the day, as a $400 million credit union CEO, my job's the same as the regulators. I want consumer protection. I want consumers' wealth to be protected. And I want legislators to let us in this game, because when you watch a community like Stillwater, Minnesota, who bans Bitcoin ATMs in their community because of elder abuse, I commend them for doing something. But at the same time, I think every local FI in that community would say, hey, let us in that space. We deal with elder abuse all the time. We're very good at it. We want to help protect these consumers. And so I think this is more revolutionary than most credit union CEOs or executives or our industry as a whole are giving it credit for. And so it's time for a deep dive, or they're going to wake up one day and wish that they had more options in front of them rather than just depending on a third party who came up with a solution that is their only choice because they have to move. So I think the more options and agility you want to be able to serve your consumers and run your institution's balance sheets, income statements, the way that you want as your credit union and how you've run over the last 100 years means that you have to start preparing for that to create those opportunities and options today. Because if you wait a year and a half, it will be defined for you. But the problem is then you're going to be basically implementing someone else's solution. And I believe there are a lot of strong thought leaders in our credit union industry who ultimately can help us shape this story to be an opportunity for credit unions in this space to really rise and continue to do what we've already been doing for the last 15 to 20 years, which is gaining market share because consumers love democratically controlled capital in their community. And they love partnering with institutions that help them protect their wealth, start businesses, and basically have their community thrive. And we are a big part of that, but we have to start looking at this industry a little bit differently with a little bit more sense of urgency if we're going to continue to be seen as that, especially by these next generations that are coming in who ultimately at the end of the day don't believe that they need a bank down the street in their community, because ultimately they don't see the fact that we have the ability to do the things that they care about, which is philanthropy, giving back to our community, people over profit, and some of the things that those generations value. We have to get into the game of convenience, into these new money networks, so we can continue to prove the story that we've proved for the last 100 years, is that credit unions are the best financial institutions for consumers to partner with.
Yeah, Robbie, I would say that for the data and statistics folks listening, I'm going to throw out some important numbers, and then I'm going to connect it to how that pertains to FI strategy and what we know the big players are doing. So Bitcoin market cap already exceeds the size of the credit union industry assets. In terms of liquidity, Bitcoin is about 6 to 8x the liquidity of the credit union space. The Bitcoin network alone moves more value annually, settles more value annually globally than Visa. A transaction on most of these new protocols is going to be cheaper, up to 1,000% cheaper than traditional FI and electronic dollar transactions. There's open communications out there from players like PayPal, Block, Walmart, et cetera. Apple's starting to signal things. Other players are starting to signal things that they're moving in the direction of incenting consumers to adopt this because of the improved security, cost, efficiency of these transactions. We've got about 100 million Americans who are either in or keenly interested in being in this space. And the statistics around that get really important to pay attention to when you get into your high net worth depositors, your younger members, your younger generations. In other words, how you're going to keep your institution alive into the future and relevant into the future. Like we could go on and on and on. The point is, the large players, the JP Morgans of the world, the Fidelities of the world, the Coinbases of the world, they already know all of these statistics and they've built business models and business plans around them. And some of them are producing billions of dollars a year in revenue already from payments and settlements and exchanges and storage of these assets. They're producing superior yields to traditional FI products. I can get a 4% yield on my US dollar coin as a global stablecoin standard, so on and so forth. They're producing better lending rates if I provide digital assets as collateral for my loan. And like I said, the big players know this and they've built product solutions and strategies around this. What I think is really imperative is for firms like DaLand to keep existing, to keep doing the 10,000 hours, to keep skating toward where the puck is going so that the credit union industry has a credit union owned and designed solution, strategically designed solution to stay relevant in the era of digital asset deposits, loans, payments, et cetera, because we already see that the big players are doing it. And I'll close with this. At a recent conference where I was speaking, I was asked, what do I hope the future of money is and what do I think it will be? Well, I hope it's decentralized, cooperative, democratically governed, that local FIs maintain sovereign control of some of their capital and wealth and can deploy it locally and regionally and cooperatively. But I think where it's heading is to hyper-centralized, authoritarian, very programmed, centrally programmed forms of money that could very easily become controlled by one or two players in the market space. And that doesn't bode well for anybody in local financial services. These evolutions are unlike anything that's happened in the past. You can't simply acquire a third-party vendor here and then still become the destination for the deposits and the payment transactions and everything because you're the licensed FI and you have the checking account. These merchants and these merchant providers and these fintechs understand that precisely the nature of the innovation of digital assets is that it collapses the layers of the depository institution and the settlement layers. So the settlement, the transactor, the Block merchant, the PayPal merchant, whomever, they become the depository institution too. So our whole strategy, our whole focus for the products and solutions and education that we're doing is to keep the local financial services institution as trusted repositories for wealth, trusted servicers for wealth, and ahead of the developments of programmable money and other maybe not so nice things that larger players are doing and already demonstrating that there's a great amount of profit and value in that space.
Well, thank you both so much, Jon and Jed, for being on the show today. Stay well, and thanks all for listening today and tuning in again next time to the CUInsight Network.
Thank you, Robbie.
Thank you.